All right, let's get started. How's it going, guys? My name is Tom Martin. I'm the president and founder of ClearPath Financial Planning. And what I want to do is just kind of do a little view as far as what we offer in terms of student loan advising, what that looks like. How do we actually come up with the strategies in there that help you? Are we just kind of using common sense knowledge here, or are we crunching numbers? So we're going to dive on in and kind of show you how we make our decisions and offer you the financial strategies to help you create a life that you love. All right, so let me say that there comes a point in everyone's student loan journey where they start to second guess the strategy that they've been following for quite a few years now. Maybe your balance isn't dropping as fast as you'd like, or maybe it's going up, as nuts as that sounds. What you need to understand here is the net cost of mistakes made around student loans adds up to tens of thousands of dollars, if not $100,000 or more. So in my firm, we offer financial planning that incorporates your student loans as part of an overall financial strategy. We'll identify your best repayment strategy for you and project how future raises in income, getting married, having children, how that all affects your overall repayment strategy. All right, so I can't wait to dive into this and share with you what I do. I'm very passionate about this. I put all my blood, sweat, and tears into this to help young professionals. These are people in healthcare, law, business, and help them understand what the best options are for their mountain of student loan debt. All right, so let's dive right on in. All right, guys, so before we jump on in, I just want to give you some perspective in here about what we do at my firm. We're a financial planning firm for college-bound families. We definitely believe in thinking differently than large Wall Street firms and banks. Everything that we do here is to help our families live their most expansive and most meaningful life. And how we do this by making college more affordable on the front end, by making the most of school selection, financial aid, tax opportunities, and really by maximizing the resources that families have today. So we are not your father's financial advisor. We do real financial planning here. I love to say we're big fans of the F word here, which is fiduciary. We have our clients' best interest at heart here. And our relationship with clients starts with a focus on college or, student loans. So jumping right in here into our demo. So what we've done here is we've already done the first step. We've imported our clients' student loan data in here, as we can kind of see here. So we have a couple that's newly married, and they're kind of really wondering whether it makes sense to file separately or jointly. The wife has about $185,000 in federal student loans, and the husband is a business professional, and he has about $75,000 in student loans. So as we move into our forecasting and what's running these numbers here, we're pulling our clients' actual income that they're getting from their W-2s and their tax returns. So the wife, it makes $102,000 a year. The husband made $84,931 last year. So that's going to affect this year's payments in their student loans. But he did just get a new job and making $105,000 a year. So that's going to change things for year 2 going forward, just so that you understand how that affects some of these numbers here. So we're going to run a scenario here where they're filing jointly and see what this looks like for them. Currently, she's on an income-based repayment plan. She has older FFEL loans, which we can kind of see here. And with FFEL loans, there's not really much that you qualify for in terms of federal programs. FFEL loans are actually government-backed kind of private loans, but they're still considered federal student loans. She can earn forgiveness on these loans, but only through income-based repayment, which she's been on for the last 4 years. So we're going to just run with that and see what this looks like if she stays on the income-based repayment plan, filing jointly with her husband. And we kind of see here that her payment over the term of her student loans, she's going to pay back a good portion of these loans. I mean, she only has $185,000, but she's paying that plus interest over the term of this loan, and she will put in $327,000, 213. Versus if she were on an income-based repayment plan, a standard repayment plan, 10-year standard, she'd be paying $314,847 into this. So the numbers aren't really too exciting there. It actually looks like income-based repayment is going to cost her more over the term of her loan than a standard 10-year repayment. And that kind of makes sense because when we're looking at the annual repayment amount here, the red here is our standard 10-year payment, which is a level 10-year payment. We take the balance, split it across 10 years, and that's how we arrive at this, and should be paid off guaranteed in 10 years. Income-based repayment starts out a little lower here, but remember how I said the husband had a pay raise while he got a new job with higher income, and this accounts for inflation and pay raises here. And we could see that income-based repayment actually costs more because we have 3 more years of payments on this student loan. And just run into the ledger here, we could see that their joint payment together is going to be $2,024. They are paying principal and interest here, and they're paying the full thing, because in our outstanding interest column here, we could see that there is no interest that is not being paid or carried forward. And we could see that by 2030, her payments will be $2,800, and that the whole balance will be paid off in full. So what we see here is really the value of filing jointly here, because of the husband's income of $100,000 a year and his student loan of $74,000 in terms of his federal student loan. His debt to income ratio there isn't really going to add value to her income-based repayment plan. They end up paying this off, and she doesn't get to see any loan forgiveness or anything like that. So it's kind of nice to kind of see that. We can compare this against a 20-year extended plan. What happens if we just stretch this out over 20 years? We can see that the payments are nice and level and a little bit lower than the income-based repayment plan, but she's paying $365,918 for doing that strategy versus just staying on her income-based repayment plan and paying the $327. And then if we spread it out over 25 years, which a lot of people are tempted to do, we could see that that's going to cost $390 versus her $327 here. So what I want to do now is see what this looks like if we file separately. Is anything going to change? And I think it will. So let me show you what that looks like. All right, so I made the changes here to illustrate us filing married but separately. As you can see, my client's AGIs are the same here, so nothing is being influenced by the numbers here. And let's go ahead and run the plans. So we're still going to run with the income-based repayment plan because, like I said, she's been on it for 4 years. And as you can tell here, we do start to earn forgiveness. In fact, she'll have $152,000 discharged over the course of 21 years by removing her husband from the joint status. So she does end up running through the whole program to the end and having this number discharged here. And as we can kind of see here, over the term of her income-based repayment plan, the 21 years, she's now only paying $218,000 versus the $327, and that becomes pretty competitive with the standard 10-year repayment plan because of the loan forgiveness here. They end up paying almost the same amount. Income-based repayment does look to be a little cheaper here, and I'll explain that in a moment here, versus a 10-year standard, and we get the benefit from much lower payments over the course of time versus the 10-year standard. I mean, most people probably can't even afford this 10-year standard plan with having $185,000 in student loans and just paying it all off in 10 years. That can be pretty hard to do. So let's take a look at the ledger here, and we'll see that our payments for her are just $962, and as you can kind of tell here, we're going to be paid off in 2038, and that's the amount that's going to be discharged here. But also what you can tell here is that she's paying pretty much interest only. She's paying some principal, but she's paying a lot of interest. So she's kind of treading water here in that she's not really fulfilling the full interest that's due. So when you don't pay the full interest that's due, the government does come on in and help with some of those interest payments, a portion of it. But what ends up happening is, over time she does end up paying the interest due. But she does get quite a bit discharged here. So going back into this, so she's in a situation where she's going to discharge $152,707.72 in 21 years. Now, when you earn forgiveness through income-based repayment plan, you need to understand too that that forgiven amount is taxed as taxable income, right? So you have someone that's making $100,000 a year and her husband's making $100,000 a year, and now in 2038 they're going to have an extra $152,000 added to their taxable income, and that's going to jump them right into a high tax bracket, right? I'm just putting in 35% in here, and that translates to a tax bill of $53,447 in 2038. So in 2038, probably when they're getting ready to send their kids off to college, they're going to get, what's going to end up happening is their loans are going to get forgiven. Their loan servicer is going to issue a 1099-C, which is a cancellation of debt, to this couple and to the IRS as well, to let them know to expect that check. And the IRS is going to be expecting $53,000 in 2038 from you. And let me tell you what, if as a business owner, I deal with the IRS quite a bit, and they're pretty hard to deal with. If you hate dealing with your loan servicer, you're going to hate dealing with the IRS. So you need to really plan and figure out how you're going to do that. I already ran the numbers, so I already know that they need to save $125 a month in an interest-bearing account. So that's like an investment account that's earning in between 5 to 7%. And now we need to go back to our situation down here, our strategy, and really see what that added amount adds into here, versus in terms of the overall cost. Because now it's not just $218,000. We need this money here in 2038. So if we save $125 a month, we're going to put in $23,816 of our own money into this. But keep in mind, it's going to be in an interest-bearing account that's going to grow to $55,000. But in terms of our money going into it, it's $23,816 plus the $218. So we're about $245,000 this strategy costs us. Okay. Which really, guys, it's not that bad compared to a 10-year standard plan of $226. I mean, what are you talking? $20,000 more for the benefit of having much more affordable payments, and having $152,000 being discharged in 21 years from now for this person. That's a huge benefit for them. So here, these people can clearly see that it makes more sense to file separately than jointly. Is that what's going to be more beneficial for you? I don't know, guys. You have different student loans. You work for different employers. You might have a different strategy overall. All right, guys. I hope you found that to be very insightful on how we perform our student loan advising. Using real numbers, we're crunching the data. We're comparing every single possible option to see what's the most ideal strategy for you. If you want, we'll help you identify the most ideal repayment strategy for you based on your unique situation. If you want to see how getting married affects your student loans, if you want to see how having a child or two affects your student loan repayment strategy, we can help you with that. If you're leaving a public sector job and you want to go into private sector, we can show you what that affects your student loans. If you're working at a private law firm and you want to go into public law, as a public defender or whatnot, we could help show you how public service loan forgiveness can affect your student loans and how you can benefit from that. So I hope you enjoyed this, and if you have any questions, feel free, please reach out to me. As I said, this is not meant to be construed as personal financial advice for you. Reach out to your tax attorney, reach out to your CPA, reach out to your financial advisor. If you're not working with a financial advisor, by all means, I'd love to see what you have going on, what you have planned for your life, and really help you create a life that you love. And that's it, guys. So thank you so much for dropping in, and look forward to hearing from you. Bye.